Hello everybody. So this video is entitled Two Wild Wins, yet there are many stocks in my portfolio, many stocks that I cover that are left behind, and some stocks in my view are getting ahead of themselves, or at least trading not the way I like. Starting out with, for example, Hyperliquid. You may remember Hyperliquid. I covered Hyperliquid like a month and 5 days ago, literally, and it's up 85%. So that's not enough for me to build a position. I like to build a position over the long run. That's not enough. And the moves have been very much casino-like. When you have 1 month, a stock nearly doubling in 1 month, these moves frustrate me. They are casino-like, right? So you don't have time to focus on the fundamentals and get to know the company when the hype sets in. Perhaps I should have known, of course, because Hyperliquid owns the hype token. But it's the same story for another former channel favorite, right? Nebius. You may remember a year ago, I was all in on Nebius when it was $50. I liked it very much. When it was, $30, $50, I liked it a lot. Remember, I was very bullish on this one in February 8, 2025. Look at the performance. It's ridiculous. It's done a 7 times your money. 7 times your money in a little over a year. So to me, the market is moving very, very fast. And I don't like that because I don't have time to build my positions. I want to be able to add to positions over many, many, many years. So my style of investing, if you follow my style of investing, a stock like HIMS, for example, is much better suited to my style of investing because there's opportunities every year to add a little bit. A stock like Nebius, to me, is getting out of hand. The quote of Warren Buffett, of course, I'm fearful when others are greedy. Get fearful when others are greedy, right? And Nebius is one of the smaller winners. Think about Micron crossing $1,000. The market sometimes is just getting out of itself. The market looks more and more like a casino. And I also want to say this: don't forget this. We've been running for the past 5 years at about, at the very least, 1 epic crash a year, and for the past year and a half, it's been about 2 epic crashes a year. So don't forget that this market is very often 1 tweet away from everything dropping dramatically. 1 tweet away, perhaps a tariff, perhaps a random bomb dropped somewhere else. We have things on the agenda probably coming up, right? Cuba, for example, is one thing they've been talking about. So I'm not comfortable when I see a stock that has 7x'd, and when I see a history of crazy macro events that can still happen and likely will still happen over the next few years. So it's unfortunate for these two because I like these two very much, but they've run too fast. I'm waiting for a 30% correction. Okay, let's talk about stocks, though, that I've been left behind. 6 stocks left behind. Again, picking them at random. There's a lot. There's more. And I'm not going to talk about Bitcoin or strategy today, but if you look at in the Bitcoin and strategy side of the equation, that side of the equation, you'll find even more stocks that have been left behind. But I'm trying to cover some other stocks today. So one of them is SoFi. You should watch the interview of Anthony Noto with Amit. I can't remember the name of that podcast. It's Basis Points. You should watch that interview. Very, very, very good interview. I believe Noto has a very good handle on SoFi, and SoFi dropped a lot. Why? Only because of rates. Only because the market is pricing in a rate hike, and it used to be pricing 2 rate cuts. So yet again, this has to do with the Middle East. Why is the market pricing rate hikes? Because of the oil prices leading to inflation higher. And it looks like we are not getting out of the Middle East anytime soon. And so the overhang may stay for a little longer on a stock like SoFi. But if you look at a stock like SoFi, they earn a lot of revenue from fees. Fees are not dependent on interest rates. They're still growing the top line very, very, very fast. 30%, they're still increasing the book value. So the drop of SoFi has nothing to do with the underlying business. It has everything to do with multiple compression. Multiple compression, the price to book on SoFi has lowered because of expectation on interest rates. But under the hood, this business is growing very fast. CEO is more bullish than ever. You had actual insider buying. It's just about the rates. And I believe that neobanks are still the way to go. I still happen to believe we don't need 8,000 Bank of America branches. We don't need 6,000 branches for Chase. And by the way, SoFi I've used to compare to Nubank a lot. As of this video, as of my research of Nubank, I go back and forth. At some points I prefer Nubank, at some points I prefer SoFi. Right now I prefer SoFi. I don't like Nubank as much right now because there's elections coming up in Brazil. And if you look at Nubank, it seems like there's going to be some changes in the interest rates caps that they can charge on the credit card. And so I anticipate perhaps a little more short-term pain on Nubank, while SoFi, I view anything that happens right now as a catalyst for SoFi, right? If Hormuz reopens, that means that inflation is going to go down. That means that rates theoretically should go down. That means that SoFi theoretically should go back to $30, right? But right now we're still sitting down 42% from the recent high in November of 2025. I think the stock has been left behind. I think the stock will catch up. Moving on to another stock, two other stocks. I'm going to cover them together. HIMS needs no introduction on this channel. As you know, I happen to believe that HIMS is firing on all cylinders. The market is entirely forgetting about the Eucalyptus acquisition, which is going to add $450 million of ARR in the second half of this year. HIMS is up nicely today. We're up 6% today on HIMS. We've been up a little bit for the past few days, but I still find it too cheap. If you look at HIMS, we're still down 50% compared to a year ago. The EV over GP over RG is a 0.11. HIMS is dirt cheap. I like HIMS very much. You can see SoFi is also very cheap at a 0.22, although SoFi is not as cheap as HIMS. Reax is a stock, again, that's been left for dead. Guess what? Guess why? Well, it's because of real estate. Real estate's dead, right? If interest rates are going back up, if mortgages are firmly staying in the 7 to 8% range for a 7% mortgage, real estate's not going to pick back up. Real estate's been dead for a long time. 5 years now, right? We're coming on 5 years. How much longer is real estate going to stay in the gutters? Probably, we don't know, but it all depends yet again on the Middle East. We didn't need the Middle East. We didn't need inflation, right? So that means that Reax, through mostly macro, is down 50% year to date. And furthermore, Reax seeing probably, the CEO seeing probably that they get no respect from the market, they decided to do an acquisition. They are acquiring Remax. And people complain. People say, oh, well, after the acquisition, the top line growth will not be as good. Well, excuse me. With that acquisition, you're doubling the revenue. Like, that acquisition is doubling the revenue. So when I look at a company like Reax, and I'm still using analyst numbers, so they say between 40 and 50%. But this is not actually that number. If you actually to value Reax, actually that number is going to be closer to 150%, because they're going to acquire Remax, which is going to double their revenue. Now, the market doesn't really do much homework. They don't like acquisitions. They never like acquisitions, because when they think of acquisition, they think about AT&T acquiring Time Warner. They think about a lot of capital squandered in very large acquisitions. If you actually study acquisitions, you see that smaller acquisitions tend to fare better. Now, Remax is a big acquisition for Reax, but it is a small acquisition in the grand scheme of things. I look at it as bullish because they're doubling their revenue. Plus, to me, this transaction, Reax and Remax, is pretty clean. The family heading, Remax is retiring. It's just pretty clean to me. I don't have a problem with small businesses acquiring firms. What I don't like in acquisitions is when a very big business acquires another one. Like if you look at the Paramount acquisition recently, right? I don't like that at all. But this doesn't bother me very much. And you have a stock that's trading at 0.03. So absolutely dirt cheap. And Real Brokerage, the platform Real Brokerage, is actually taking over real estate in the US. I believe it's a superior platform to Opendoor at this point. On this channel in the early days, I used to be big on Opendoor. I've since moved on, and I like Reax better. Moving on to e-commerce, sleepy e-commerce and sleepy super apps. I like two stocks in this category. One of them absolutely dirt cheap. Another one dirt cheap too, but much like 3 times cheaper than Amazon. But Amazon is mostly a cloud business, let's face it. But twice as expensive as Kaspi. So Kaspi, Kazakhstan and Turkey, super apps. Mostly Kazakhstan, moving to Turkey. Kaspi has been super stable, super ignored. This stock is ignored by the market. This stock actually pays a pretty high dividend, like an 8% dividend. I don't like that, but I'm willing to ignore it because they're still growing the top line very fast at 32%. Kaspi used to be a bank turned super app. They used to be a bank/payment app, which is why the EBITDA margin is so high at 56%. That's the real number, by the way. That's the true number. So Kaspi, you end up with a business trading at an EV over GP over RG of 0.08, rule of 40 of 88. And this company is going after Turkey. Turkey is a market of 80 million people. It is 4 times bigger than Kazakhstan, and it's super niche. This stock, if some could say it's way out of a risk curve. I don't necessarily think that. I don't necessarily think it's that way out of the risk curve. The management seems to have a very, very good handle on the business. And then Mercado Libre. Mercado Libre, in my view, is winning in Latin America. They are doing much better than a lot of competition, including Amazon in Latin America, including Sea Limited in Latin America. And Mercado Libre has an exciting fintech division, right? Just like Kaspi. Kaspi does finance. Mercado Libre has an exciting payments business, exciting fintech division, which I think is seeing a lot of traction. If I were going back to Nu, if I were to invest in Latin America, I prefer Mercado Libre over Nu right now. And it's cheaper than Nu, by the way, at 0.17. And I think it's really resonating with the market. The market cap, of course, for Mercado Libre 2 is only $85 billion. So, to me, over the long run, you have much greater potential for compounder over the long run. Again, I like these stocks. You can add to them on a regular basis. You can study them on a regular basis. And they don't do a 6x on you in a year. Because if a stock is able to do a 6x on you in a year, don't forget it can also do 80% down the next year. Right, that's the volatility. That's how beta works, right? So anyways, I like these two. And the last stock, and my viewers are probably going to say, what? Why would you be interested in Meta? It only grows well. It's actually not bad. It goes at 22% in the next 12 months. So it's a little off from my 30%, but think about that. 22% revenue growth for Meta. That's huge. This is a big business, 1.5 trillion, which is not slowing down, which is growing very, very fast. And it's the cheapest Mac 7. In fact, I compare all of the Mac 7 in my spreadsheet. It is 50% than NVIDIA. NVIDIA on enterprise value over gross profit over revenue growth is actually a 0.64, something like that. Meta is 50% cheaper than NVIDIA. It achieves a rule of 40 at a 73. And why do I like Meta? Well, if you look at the past year, it hasn't done much. It's been flattish, but you know why I like Meta? If we get a crash, Meta helps you. If we get a crash, Meta can save your portfolio. Why? Because it's super marginable, highest quality asset, right? It's not treated like a SoFi or like a Nebius or like a hyper liquid debt in your portfolio at your broker. Meta is treated as the most pristine collateral, and so in the event we get a very, very bad crash, this is the type of anchor that can be very helpful in a portfolio. And I believe the more hype we get, and again, I believe AI is real. There's no denying that. But I think we're getting ahead of ourselves. If we keep going like this for a month, we might be due for a crash. And this is the type of stock I want to have in a portfolio if we are due for a crash on a lot of AI stocks, because this stock, I believe, would move less because it has barely moved. And in addition to that, Meta is investing heavily in AI, and that's probably why the stock is not up as much, but it's investing heavily in AI to make their ads more effective and their apps more addictive. And I use X. I don't use any of the Meta apps, but I know Instagram is supposed to be even more addictive than X, right? And so these apps are about to get a whole more addictive, and people are going to be a whole more engaged. Much more engagement coming up on these apps. And so that means that people can't live without them. That also means that, and I'm very excited about that, how 4 days ago they launched Instagram Plus, Facebook Plus. How many people are going to subscribe to Instagram Plus? Right? Because if you see X Premium is a real success. A lot of people subscribe to X Premium. How many people on Instagram are going to pay $3 a month or $4 a month? I guess it's $4 a month. How many are going to pay that to get access to some premium features? My guess is you're going to have a lot of people who are going to take them up on that offer. If it is to see less ads, if it is just to see less ads, Meta platforms can just ramp up the ads, increase the ads, and sell you Instagram Plus if you want to see less ads. And we have 2 more catalysts in addition to Instagram Plus. Meta glasses. Meta glasses are real. They're a real option in the sense that if AR, VR becomes a thing, I think Meta glasses could be some of the top players out there, and the Ray-Ban Meta glasses are actually taking over social media. They're actually a pretty big deal, and they're doing very well with those, even though Meta has been dismissed in its AR, VR prospects for a long time. And we have the midterm advertising catalyst, which I'm sure CNBC will mention and will quote-unquote promote when we get to the midterms. Meta, of course, is cyclical on this one. It can benefit from more advertising spend, like will come on the midterm. And so, to me, I see a lot of catalysts on Meta, and I don't see that much downside because it's already the cheapest Max 7. And I like Meta at this price. So even though EV over GP over RG is 0.4, remember, for example, a SoFi, what is SoFi? 0.22. So of course, on my growth adjusted metric, Meta looks twice as expensive as SoFi, but Meta is the most pristine collateral you can get in a portfolio, right? SoFi is not. SoFi might be one day, but it's not. It's not right now. Meta is a top world company. SoFi is an up and coming bank still. So to me, I find Meta too cheap anyways. So that's just me. Hopefully this gives you some ideas as to what I think of the market right now. And I think many names are getting ahead of themselves. That's what I think. And I'm growing more fearful as I see so many people getting very, very greedy. I'm growing more fearful. So anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.